Welcome to Kalki's education series. The topic for today is Sharpe ratio. So what is Sharpe ratio? Initially developed by Nobel laureate William F. Sharpe, the Sharpe ratio is used to evaluate the risk-adjusted return of a portfolio. The ratio comes very handy for risk analysts in measuring the risk-adjusted performance of a portfolio, and it basically informs how much extra return an investor would receive on holding a risky asset. Risk-adjusted returns are usually defined as a return earned by an investor above the prevailing risk-free rate in the market. That is, return delivered by risk-free assets such as fixed deposit, supranational bonds, and government bonds. The standard measure of risk inherited by an investor by putting the money in a risky asset such as equity is typically measured in terms of standard deviation, that is, the square root of variance. To gauge the risk through Sharpe ratio, investors ideally look for a higher Sharpe ratio, as a higher ratio indicates better return yielding capacity of a portfolio for an additional unit of risk taken. Now, for example, if a fund is showing a Sharpe ratio of 2%, it implies the portfolio would generate 2% extra return on every 1% of additional annual volatility. Now, let's have a look at how Sharpe ratio is calculated. Sharpe ratio is equal to average portfolio return minus risk-free rate divided by standard deviation of the portfolio return. Basically, a portfolio with a higher standard deviation should maintain higher Sharpe ratio to convey the idea that the additional unit of risk undertaken by the portfolio is generating a higher return. However, a portfolio with a lower standard deviation of returns could maintain a higher Sharpe ratio by generating consistent returns to convey a better performance in terms of risk-adjusted returns. The ratio has become one of the most widely adopted methods for reckoning the risk-adjusted return of a portfolio. Now, let's have a look at the uses of Sharpe ratio. Number 1. To evaluate the past performance. Number 2. To compare the portfolio performance. Number 3. To compare a portfolio performance against the benchmark. And lastly, in optimizing the risk-return trade-off. However, Sharpe ratio has its own drawbacks. Number 1. As the measure is a ratio, it doesn't work on standalone basis and often requires time series or cross-sectional comparison. And number 2, it often does not purely account for the diversification risk. Well, we hope this was informative. For more such videos, please log on to our website and subscribe to our YouTube channel. Till then, stay tuned.